Hi there. As MTA advisors, we explain how agricultural land transfers may qualify for valuable inheritance tax relief.
On April 6, 2026, the legislative framework for UK agricultural succession changes. For decades, family farms could be passed to the next generation without an inheritance tax charge. Under the new rules, that tax-free status is no longer a default. Previously, agricultural property relief was unlimited at the 100% rate. Now, that full relief is subject to a combined cap of £2.5 million per individual. Any qualifying value above that limit loses its full protection. This excess value qualifies for a 50% relief. Because the standard inheritance tax rate is 40%, applying a 50% discount results in an effective tax rate of 20% on everything over the cap. With average arable land prices near £10,000 per acre, this ceiling protects roughly 250 acres. For larger commercial holdings, mathematical restructuring is now a necessity for the farm to survive the transition. To see the impact, consider a single owner with a £4 million farm. The first £2.5 million is fully relieved, but the remaining £1.5 million is taxed at a 20% effective rate, creating an inheritance tax bill of £300,000. Assets must qualify for relief. Farmhouses, for example, must be character appropriate to the land and actively used for agriculture to keep 100% relief. Married couples can mitigate this by transferring unused allowances, creating a combined £5 million relief shelter. In our £4 million scenario, this shelter covers the entire farm's value. Structured correctly, the previous £300,000 tax bill is reduced to zero. The decision of how to legally divide farm ownership between spouses determines whether that liability remains or disappears entirely. If the new cap creates a tax charge on death, it may seem logical to gift the farm to the next generation today. Gifting land uses holdover relief, passing the original base cost to children. Holding it until death provides a death uplift, resetting base cost to market value. The trade-off: avoid a 20% inheritance tax, but risk a 24% capital gains tax upon sale. If the inheritance tax bill is unavoidable, the government does offer one concession. The tax on qualifying agricultural property can be paid in 10 equal interest-free annual installments. Finally, there is the anti-forestalling rule. If you gift land today but die within 7 years and after April 6, 2026, the gift is pulled back into the estate and assessed under the new capped rules. Gifting the farm without a long-term plan often trades a potential inheritance tax problem for a guaranteed capital gains tax trap. Strategic planning relies on the fact that the £2.5 million allowance refreshes every 7 years for lifetime giving. By staggering gifts across several decades, a family can move estates worth tens of millions of pounds entirely tax-free by utilizing that refreshing allowance cycle. The 2026 landscape requires managing 4 variables: the £2.5 million individual cap, the 20% effective tax rate on the excess, the £5 million combined spousal shelter, and the 24% capital gains tax trap. This video is for educational purposes only and does not constitute formal tax or legal advice. Navigating these overlapping taxes requires technical precision. Contact my tax accountant for tailored structuring and subscribe for more insights on the 2026 tax transition.